Hello, it's ChewDog Charts. Have you ever heard of the Super Bowl indicator? The Super Bowl indicator says that the stock market goes up if a team in the National Football Conference, or NFC, wins. Now, if a team in the American Football Conference, or the AFC, wins, then the stock market goes down. And this theory was correct for 15 of the first 16 Super Bowls. However, recently, the Super Bowl indicator hasn't done all that well, with 5 being correct and 5 times being wrong over the past 10 years. But some still cling to this mystique nonetheless, with the Eagles being from the NFC winning here recently. Maybe the stock market's going to go up, and the stock market is actually recovering as we speak. But we'll have to wait to the end of the year to see if the Super Bowl indicator is correct. When it comes to other indicators for business cycles, economists have always had creative ways of calculating where in the business cycle we are at any given moment. Starting in the 1920s, an economist came up with the hemline index, which suggested that the length of a woman's skirt tracked stock market performance, rising and falling in tandem. In good economies, we get such results as miniskirts, while in poor economic times, as in the 1929 Wall Street crash, hemlines can drop almost overnight. Decades later, former Fed Chair Alan Greenspan used to track sales of men's underwear, which he said fell at the onset of a recession as men delayed buying new underwear during tough economic times. And just as a side note, I have new underwear. All right. Maybe that's a little bit too much information. Then there was the lipstick index proposed by Estee Lauder chairman Leonard Lauder in 2001. He claimed that purchases of cosmetics were inversely correlated with the health of the economy. The 2008 recession gave rise to the tie index, sales of which it was claimed rose as employees feared for their jobs. According to new research, there's a new indicator that can warn of a coming recession: sex, or rather, the 9-month consequences thereof, and the rise and fall of pregnancies. So let's take a look. According to a recently published paper by the National Bureau of Economic Research, based on the past 3 U.S. recessions, the number of conceptions began to fall at least 6 months before the economy started to contract. While previous research has shown how birth rates track economic cycles, this scientific study is the first to show that fertility declines are a leading indicator for recessions. One of the authors had stated it was striking that the drop in pregnancies was evident before the recession that came after the 2007 financial crisis, since it has traditionally been argued that this slump had been hard to predict. It may be difficult for experts to identify economic conditions, but apparently not for a couple deciding what to do next in the bedroom. The analysis used data on the 109 million births in the U.S. between 1989 and 2016 to examine how fertility rates changed through the last 3 economic cycles. The first cycle in the early 1990s, the second cycle in the early 2000s, and the third cycle in the late 2000s. And in each case, a similar pattern emerged. The researchers focused on birth data from the National Center for Health Statistics, looking at clinical estimates for the month of conception. They compared that to the dates of the recessions and to changes in the GDP. The change in birth rates was driven by a drop in conceptions, not an increase in abortion or miscarriage, the researchers found. In other words, less sex with the intent to procreate. To their surprise, they found that declines in conceptions were a far better leading indicator of recessions than many commonly used indicators such as consumer confidence, measures of uncertainty, and purchases of big-ticket items such as washing machines and cars. Take the Great Recession. The U.S. birth rate rising before the recession, fell in 2008, as one might expect. But before that, in the middle of 2007, the subprime mortgage crisis was hurting the housing market, but the broader effect on the economy was not yet apparent. But stock prices kept hitting all-time highs, unemployment was well below 5%, and analysts were confident and optimistic. It was months before the recession began and more than a year before the collapse of Lehman Brothers triggered a global panic. The researchers found the U.S. conception rate had already started to drop. While the best of experts didn't see the Great Recession coming, it seems that families and households were feeling those tremors and responded to it. The researchers suggest several possible explanations, including the natural time lag with attempting to conceive, the increasing age of first-time mothers, and the growing popularity of long-acting birth control. And to this new chart here shows that, to be sure, this may be just another case of curious correlation. And researchers admitted that the correlation between conceptions and recession is not perfect, and there have been periods when conceptions have fallen, but the economy did not. So that brings the question, what does the latest data indicate? Well, as the chart shows, after peaking sometime in 2013, the U.S. now may be leading into a real deep recession, at least based on the pregnancy rates. And to end with is this picture of a stork. No, it's not delivering a baby. It's delivering my next video. And I am doing some research right now on the next bull market. And I'm also doing research on some stock market myths that I think you'll find interesting. And further, I'm continuing to monitor GE. I've been requested to do a video on GE, but I want to do it at the right time. So I'm watching GE here. Now, the research on these next coming videos are taking a little bit longer than I anticipate, so I might not have a video coming out this weekend, but if not, it will be delivered shortly. So until then, that's ChewDog Charts. Thank you.